Hi, I'm Greg Hunter. Welcome to USAWatchdog.com. With us once again, gold expert James Turk of goldmoney.com. James Turk, good to have you here today.
Thanks, Greg. Good to be with you.
Well, let's start with the wild gyrations of gold last week when Ben Bernanke talked. I mean, at one point, it was up $50, and then it was down $20. It was a $70 swing. What do you make of, Ben Bernanke as he's talking, saying he's going to increase it, he could decrease it, he could taper it, he's going to wait till the market comes? I mean, a little something for everybody in that speech, wasn't there?
Yeah, there really was. He was talking out of both sides of his mouth, and depending what you wanted to hear, you heard it. And that's why we had that tremendous volatility in the market. But you know what was going on over here in London was very interesting, Greg, because during all of that, you had the physical demand for gold going up, and you had a very high London PM fix that day. And as a consequence of that, it shows what kind of stress and strain you're seeing in the gold market. It's basically suggesting to me that at this level, we've probably gone as low as we possibly can. The paper traders, the derivative traders pushed it as far as they can, but the demand for physical metal is just extraordinary down here at these levels.
I want to talk to you about, because you are in the outskirts of London, you're in the UK, and you're attuned to the London Bullion Market Association, the LBMA. It's so funny, they treat it out like a futures market, still in a way do, but it's really a bullion market. Is there a chance that the LBMA could face a force majeure if things keep going the way they do with the Indians, the Chinese, the Russians, the Brazilians, everybody buying gold?
Yeah, that's a good question. First of all, the LBMA is an association. It's not an exchange. What it is an association of market makers and people who are involved in the gold industry. And they interact or they trade with one another. It's always possible that one party to a transaction could default, and you then have a counterparty risk and a default. And that could have a knock-on effect through other members. But remember, there is no clearinghouse like there is with the COMEX. In the COMEX, all of the members form a clearinghouse and stand by the other members. That's not the way it works over here in London.
So you could have individual defaults on delivery of gold. Is that what you're saying? Is that right?
That's exactly right. And in effect, we had defaults when Lehman Brothers went under back in 2008. What Lehman Brothers was doing was, they had various commitments, and they could not fulfill those commitments. And in order to prevent a more massive collapse, at least on the paper side, the government came involved and bailed out Goldman Sachs and all of the other counterparties to Lehman when Lehman went under. Now, you could have a similar type of thing in the physical gold market. If there are too many commitments out there and there's an inability of one of those counterparties to make good on the promise to actually deliver gold, in which case you would have a force majeure.
Are we getting to a point where that's going to become common over in the LBMA over in London?
Well, it shouldn't be common. The market should operate at a normal level without government intervention, without interference. But we're at an extraordinary level. There's so much involvement by government in the market at various levels. Even on the interest rate side, gold normally trades in a relationship that's based on interest rates against various currencies. And we're seeing a lot of intervention on interest rates, and that's affecting the way gold's trading as well. So, is a default possible? Yeah. A 2008 event could be happening. But, if there is a force majeure, what's likely to happen is the party that's supposed to deliver gold is going to say, look, we don't have it. It's a force majeure. You're out of luck. You're going to have to go find your gold somewhere else. If that were to happen, it would light a fire under this market, and the price would rocket higher.
And you think that they've done all they can? 1380 or 90 or wherever it is now is just about the bottom for gold. Silver's at around 22. At least it was last week when I looked at it. So
yeah.
You're saying that gold and silver physical is just about where it's going to be. What about all this talk of gold going to $700 an ounce and silver going to $7 an ounce? What do you say to people like that?
Yeah. Well, when it comes to markets, anything is possible. And, to be quite honest, I didn't think we were going to be, in the 1300s, a couple of months ago. I would have probably assigned a 10% probability to it, meaning, anything's possible, but it's very unlikely. To get these kinds of low levels in the gold price, you're going to have to see a massive destruction of dollars. You're going to have a massive dollar deflation. And that's really just not happening. Now, the interesting thing is there is some implications of deflation in the Eurozone. For example, all of the deposits in Cyprus basically disappeared. If you reduce the amount of deposits in circulation, or the amount of deposit, you're reducing the currency in circulation, the total quantity of currency, and that's potentially deflationary. So, you've got a potentially deflationary situation with the euro, but given what Mr. Bernanke is doing at the Federal Reserve, you've got a very inflationary situation with the U.S. dollar. And as far as gold's concerned, its relationship to the dollar is more important than its relationship to the euro.
You must have clients say, "Hey, listen, I'm worried about bail-ins in Spain and France and Italy and Portugal and all over the euro." And they're talking about the next time we have one of these crack-ups, and I think you and I both agree we're going to have another crack-up. We're headed for another fall, that they're going to have bail-in programs. It's pretty widely talked about over in the EU. Are you having clients freaking out and wanting to even amass more gold, physical gold, in their possession?
Well, we had some very happy customers in Cyprus, to be quite honest, because they actually had physical gold rather than having money on deposit in the banking system. There is a lot of nervousness here in Euro, and I think in Euroland. And one of the reasons why I think that the stock markets around the world are rising is big institutional investors realize that it's not safe to keep their money in the banking system anymore because it could be used in a bail-in, because there's so many insolvent banks, not only in Europe but elsewhere. But let's just focus on Europe for a moment. That what's an institution going to do? It's going to have to take its money out of the banking system and put it somewhere. You can't put it in bonds because that bull market is over. And in any case, you just still have exposure to the currency. You don't want to put it back into the banks, obviously. You're going to put it into the stock market, or you're going to put it into a tangible asset like gold or other tangible assets. And, that's why the stock markets have been booming, and I think gold's about ready to start booming here as well. A week ago Monday, felt like a selling climax. You had a huge down move and then it reversed back, both in gold and silver. So my guess is that's probably the low, given the stress that we're seeing in the physical market down here at these prices.
Would you hazard a prediction for gold for the end of the year?
Well, I keep comparing this situation to what happened back in 2008. After that low in 2008, within 12 months, gold made a new record high, over $1,000, and the price of silver doubled within 12 months. So my expectation is that we're going to see something similar. Within 12 months, gold's going to make a new record high, over $2,000, and the price of silver will double within 12 months. It could happen sooner, depending on how events unfold, and particularly if we don't see some ratcheting up in the gold price to release some of the stress that we're seeing in the physical side of the market. But there's no reason to suggest that the bull market in gold has ended. This is like 2008. It's one of those periods of time that, maybe it's a little bit worrying if you're trading metal, but, I don't recommend trading it. What I recommend is just accumulating it. When you're accumulating metal, you're basically saving money, and you're saving sound money, which has been very, very good, given what gold has done over the past, 12 years. And also given the fact that when you're saving gold, you don't have to worry about bail-ins. You don't have to worry about inflation or what the government might do, because you actually own a tangible asset.
You think bail-ins are going to happen next time we have a meltdown?
I do, because, I think it's a recognition by the authorities that the problems in the banking system are so bad that the assets that they have in the banks are so impaired relative to the capital base in those banks that it's inevitable in my mind that you're going to see more bail-ins as we go forward from here, because the capital doesn't exist. So you have to reduce the leverage. The assets are already reduced in the sense that you have to account for the bad assets. So they have to reduce the deposits in order to bring balance sheets back into balance. And what that means is you're going to see bail-ins, I think.
And not even phony accounting can give you capital, now can it?
No, it can't. And the other thing that can't give you capital is some of these governments here in Europe think that they can go out and borrow and recapitalize the banks that way. But that's not capital. You're just adding debt onto debt. You're just removing, the leverage, from the bank itself to the government. So that's not solving anything, particularly given the fact that most of these governments here in Europe are themselves way highly leveraged, way too much debt. And any kind of increase in interest rates is going to make that debt even more of a burden. And I suppose that's the interesting thing that's happening here too, Greg, is that, interest rates are starting to back up. You've got the 10-year U.S. back above 2%.
Yep.
You saw a huge increase in Japan. It's also happening even in places like Germany. Interest rates are backing up. So I'm basically prepared for something serious to happen over the summer.
Your advice to people holding or buying gold and silver? I know you sell it, so you're kind of talking your book. What would you advise people?
Well, it's the same thing I've been advising, all decade long, or since I first launched Gold Money back in 2001. First of all, everybody needs to save money. We very rarely hear that these days. But you need to save money for the future, for a rainy day, to buy a consumer good or whatever it happens to be. But it doesn't make sense to save any national currency because the interest rates are just too low. And it doesn't compensate you for the risks that you're taking when you have money on deposit in the banking system. So what I essentially have been recommending is just accumulate gold on a regular cost averaging program, month in, month out, whether it's $500 or $1,000, just, continue to save that money, even if it's $100. Just continue to save, buy that same amount of gold or silver if you're so inclined every month, month after month, and just view that to be your savings. And it's worked very well. Gold is up 12 years in a row against the U.S. dollar at an average annual appreciation of 16%. And I don't see that to change any time in the future, given that the problems that we've been confronting for the past several years, they haven't gone away. They haven't gotten any better. Government's been trying to buy time, but they're not actually coming up with solutions.
Oh, it's great. Government's buying time and not actually coming. If they wanted to come up with a solution, they take these banks to receivership. They mark down their capital. A lot of executives would be fired. They would just insure the depositors, but they don't want to do that. One last question. You talked about the dollar, and the currency trader from your neck of the woods in the UK said, "Oh, the dollar's going to go higher. It's going to rocket. It's going to go up from here. It's going to go straight up from here." And even one of the CNBC hosts went, "Well, what about all the debt the U.S. has and all that? Is the dollar going to go straight up from here?"
Well, the dollar has some benefits. The fact that the energy discoveries in North Dakota are reducing, the U.S. Dependence on imported oil and imported energy. That's going to help to a certain extent. But on the other side of the equation, it's not going to stop politicians from spending money and making promises. And that's the real issue. And with the eliminating of the debt ceiling, as we did earlier in this year, and we're now operating again without a debt ceiling, basically, what that's done is it's removed the last little bit of discipline on the monetary and fiscal policy. And in that environment, inevitably, currencies ultimately collapse. And, Greg, it's very simple, really. If you go back and look at monetary history, the solution is always, always, always a higher gold price. And governments either accept that willingly or they're dragged to that ultimate realization, kicking and screaming. But a higher gold price is always the way to solve the problem. And it could happen here too, but it's going to take a much, much higher gold price, for the governments to impose that discipline once again on the monetary process, which is essentially what we need.
James Turk, goldmoney.com. Thanks for joining us today on USAWatchdog.com from beautiful London, England, or just outside of London.
Thank you, Greg.